gold will be revalued at a much higher level. That's not pie in the sky. It's held in foreign central bank balance sheets, and an account can't make it up, called the gold revaluation account. The head of the Dutch National Bank keeps saying we should revalue our gold. It's still valued at $35 an ounce, the old Bretton Woods price, and it can't offset liabilities. They want to change the rules. They want to jack gold way up and offset the liabilities on their balance sheet with the price of gold and peg it to a new system.
Silver and its never-ending demand prospects global demand to reach new heights. Industrial demand is at the center of the change in the supply and demand landscape. They believe that by the end of 2024, industrial consumption will have reached 700 million ounces this year. This would represent a 7% increase. The electrification of everything from solar panels to electric vehicles being major drivers of this demand. It is because of this that silver stands out as the metal whose uses seem to constantly grow. Silver jewelry in all markets is expected to grow, no doubt supported as well by the meteoric rise of the gold price. Golden products will still take a good share, but to fit the price targets, the public will see more silver jewelry plated with gold, providing the same luxurious look at a significant discount. Silver retail investment is not expected to grow and has had a significant drop in demand, especially in the USA, where it is believed to be about a 40% decline. The reason for investment in precious metals has not dissipated since the U.S. debt crisis remains. The election of Trump to the presidency in the USA has given some comfort to the public that the U.S. will regain control of its spending and debts. And this is why we have been seeing the recent price declines in silver and gold. On the other hand, the silver exchange traded products have had significant inflows of close to 8% year-over-year. As the market knows, these investments are typically very sticky and do not represent a threat to the market supply structure at current price levels. Mining and recycled supply of the metal is not meeting current overall demand. Metals Focus expects this deficit to remain for the next few years. Well, from my point of view, the fundamentals support healthy demand that will not be going away anytime soon. This I call the most basic market support factor. Then you must consider inflation, the global debt crisis, the currency wars, BRICS, and the unknown. Gold is the leading indicator for these factors. And though it has suffered a significant price correction since the elections from the short-term high of its prospects, this exuberance and expected relief from mismanagement of the USA's economy will be short-lived, as the problems built up over recent decades will not disappear. In my estimation, these price dips represent a real opportunity to build a safety net that will work to offset future weakness in the U.S. currency and economy. Now we'll show you more clips, but first smash the subscribe button and turn on notifications so you do not miss out our recaps. Enjoy the episode.
Originally, it was a basket of commodities, but they say the unit token, the white paper, says a basket of 40% gold in kilobar form that is deliverable upon request. In a basket, 60% of BRICS plus currencies with not any more than 30% of any one currency being in that basket. So it's just gold, and that makes sense. I mean, gold was reclassified by the Bank of International Settlements in 2019. There's the BIS again, as the world's only other tier one reserve asset. And if you look, and that's next to US dollars and treasuries, but if you look at all of the gold accumulation and repatriation by the central banks of the world, it makes good sense. And that's why a lot of people believe gold will be revalued at a much higher level. That's not pie in the sky. It's held in foreign central bank balance sheets, and an account can't make it up, called the gold revaluation account. The head of the Dutch National Bank keeps saying we should revalue our gold. It's still valued at $35 an ounce, the old Bretton Woods price, and it can't offset liabilities. They want to change the rules. They want to jack gold way up and offset the liabilities on their balance sheet with the price of gold and peg it to a new system. As crazy as that sounds, Cynthia Loomis, the senator from Wyoming, said the same thing at the Bitcoin meeting in Tennessee not too long ago, right after Trump spoke, saying, yeah, I would consider building a strategic Bitcoin account for the United States. She gets up on stage and says, I'm creating a bill to float to Congress that will revalue the gold held by the Federal Reserve on behalf of the U.S. Treasury to a level high enough to where we can take a portion of those funds and buy the Bitcoin for the strategic account. It wouldn't surprise me if they revalue gold, and it wouldn't even require congressional approval. Janet Yellen could just tell Jerome Powell, here's what the price of gold is, and anyone that wants to sell it to us, to the U.S. Treasury, other nations, will pay them X for it. Every $4,000 increase in the price of gold equates to $1 trillion free and clear to the U.S. Treasury general account. As crazy as this sounds, why not put gold at 130,000 an ounce? A Bitcoin can go there. People don't think twice about that. What do all the central banks own? Gold. What have they all been buying? Gold. What have they all been bringing home? Gold. Would it behoove them all to have gold much higher, that they could offset their liabilities? Sure, it would. It's almost a form of a reset now. It would create a lot of inflation and would have consequences to it. But if we put it at 130,000, it just like that would offset our 36 trillion in liabilities. As crazy as that sounds, over my shoulder is President Roosevelt. He did something similar. Gold was money back then in 1933. Everyone owned it, but he confiscated it and then devalued the dollar by 40% immediately, and gold went from 20 to 35, just like that. And that reliquefied the entire treasury. The same thing could happen here. And in a world where all of these countries have been buying gold, look, if you talk about a system, so you already have the former president of Brazil and the head of the new development bank saying, yeah, we're going to peg it to gold. Look at the IMF. They came out with a report last year saying gold as a international reserve currency, a barbarous relic no more, ? And then you have Kristalina Georgieva, the head of the IMF, saying a CBDC not pegged to something is fiat. Well, what would you peg it to? Gold. They're using a 40% pegging. That's what the Swiss used, before they delinked it from their constitution. That gives you 60% monetary maneuverability, but you have to peg gold at a much, much, much higher price. So, yeah, could they do it? Could they revalue gold? Sure, they could. And that is what the price is. I mean, in China, the price of silver has been $4 higher than in the West. Is that what the price is? Sure, if you can deliver it there. But if globally gold is then set at a much higher price, it offsets the liabilities on the balance sheets that is then used to peg to a new system with a marriage between blockchain technology and the price of gold, so that you're showing immutability and veracity for the whole world to see, have it independently audited. Sure, it makes sense. I have no proof that this will happen, but when you hear the head of the Dutch National Bank continually say it, when you hear Cynthia Loomis say it, it's something that they notice. Look, Jim Rickards says it all the time. He says gold's going to 27,000 an ounce based upon pegging it to the M1 money supply. There are a lot of people who will take other numbers, take the M2 and it goes higher, take our debt and divide it into the gold held at Fort Knox, supposedly, the 8,300 metric tons, and you come up with much, much, much higher numbers. And that's how you offset your liabilities. You revalue, and when you realize that gold's held on every central bank balance sheet in an account called the gold revaluation account, you start to wonder, could this actually happen? So, not saying it will, but it is an option. It's much easier than default to just simply say, we'll can print the money to pay everyone that they want to sell you their gold, but this is what we're willing to pay for it. This is the official price. That is the official price, and it is that easy. Doesn't mean it doesn't have a lot of consequences, but it's something that the politicians certainly notice.
In today's news recap, silver dips under $30, recovers quickly. JP Morgan analysts suggest sell-off is short-term and the debasement trade rumbles on. Silver prices moved under $30 an ounce in trading Thursday morning. Still, prices recovered after the United States released its producer price index data, showing a rise in prices and suggesting slightly higher inflation in October. Precious metals have been trending downward following the U.S. election of Donald Trump to return to his previous post as president. Gold traded in the $2,570 range Thursday morning. Reduction in supply. On Wednesday, the Silver Institute Industry Association said it expects the global silver deficit to fall by 4% in 2024, with a 2% supply growth offsetting a demand boost of just 1%. The Silver Institute expects a 5% increase in supply due to a spike in Western silverware scrap. Strength of the dollar. The U.S. dollar has surged in foreign exchange markets after the election of Trump, who campaigned on a nationalistic economic strategy. The move surprised JP Morgan analysts, who released a note Wednesday stating, "The swift move lower in gold post-election ran counter to our strategists' expectations. However, they think the sell-off is a stumble, not a sea change." The note continued, there isn't a break in thesis that a Republican sweep of government will likely continue to fuel further upside for gold in 2025 as the debasement trade rumbles on. Now we'll show you more clips, but first smash the subscribe button and turn on notifications so you do not miss out our recaps. Enjoy the episode.
You get into something like yield curve control, where the Fed is the buyer of last resort. They monetize the debt, which leads to hyperinflation, ultimately, which leads to much higher interest rates. And that's the problem. If we weren't the world reserve currency, if we weren't reliant upon so much in the way of foreign investment into our treasury market in order to finance our debt, which is becoming very large. And not only that, when you talk about the need to come up with over 10 trillion in bond sales, every single year for the next several, just to finance the debt that is coming due and the debt that we have outstanding, to keep the lights on, it becomes very concerning. Who's going to buy our bonds? And that's when the weaponization of the bond market and the sanctioning of countries really starts to muddy the waters, because not only are you looking at an asset like the 10-year treasury that has, I would argue, underperformed. I mean, gold has doubled the performance of the 10-year treasury for the last 25 years, if you look at it over that span of time, and it doesn't have the counterparty risk that we've seen with the 10-year treasury, or with the treasury market in general, rather, where the United States, if they feel that we don't align ideologically and we don't like what you've done, we'll take your money, or the European Union for that matter. So the West has proven that they will, that the treasuries can be weaponized, and that if you're on the wrong side, well, then you'll get it confiscated and maybe even given to the country you're in the midst of a war against in the form of weaponry. That's a line that's very difficult to come back from. So when you add into it weaponization, sanctions, inflation, who the hell wants to hold our treasuries? Why not hold something like gold, which has doubled the performance of the treasury, has no counterparty risk, and if it's in your possession, cannot be confiscated? That's why you're seeing the central banks, on one hand, buy so much in the way of gold, because it's an asset with no counterparty liability that has outperformed the treasury. And you would think that a country that would really want to continue to be the world reserve currency would cling to the privilege and do all we could to foster confidence in this country. And the things that we've done over the last 4 years are contrary to that. And that's why I say that the current administration, now Trump isn't in yet, he's the president-elect, but the current administration, the Biden-Harris administration, in my mind, has done more to destroy this country than any external foe could have ever have done. And there's a lot of rebuilding that needs to be done. But the issue with a lot of this, Anthony, is that for 15, 20 years of suppressed interest rates. When you mess with Mother Nature and you step on interest rates, you create distortions in asset prices. You create misallocations in resources and capital, and you have markets that are at all-time highs in stocks and real estate. And now we're going to lower rates again. This is creating more of the same issue. Trump wants a lower dollar and lower interest rates. Well, that's all great, but that's not what it takes to fix the problem, as far as I'm concerned. So it's the opposite. That's what got us into this problem to begin with. So at some point, you have to address the issues. And when you take out of the equation the foreign investment from the traditional centers of countries that were, buying our treasuries and funding our standard of living, well, then it becomes a much bigger problem. Those countries are, China selling treasuries, Japan is selling treasuries. These countries that have been holding our treasuries, Saudi Arabia, they don't want to do that anymore, and I don't blame them. So it becomes a bigger problem. How do you finance the debt problem, especially when you want to lower taxes? Where does the money come from? That's an issue. And so, tariffs, that's something, but tariffs are higher prices are passed on to the consumer. If you create tariffs across the board on all of these countries, they'll just raise their prices. They're not going to eat it. They'll raise their prices, and it comes across to us as higher prices. So there isn't a magic bullet, but the distortions that have been created over the last 20 years have to be dealt with. And if you come in and try and lower rates, that's why the bond market says no. And that's why gold has been going higher and higher and higher, because it sees through all of this. And I don't think that the Trump administration will fix what ails this country financially, but it may get us on the right path, because it's going to take some time and it's going to come with some pain. And until there are politicians who have, I guess you could say, the courage to really do that, to rein in spending, to massively cut spending and get us back on a path of fiscal sanity, you can't increase spending and cut taxes. It doesn't work that way. So I guess we'll see
What are your thoughts on Andy Schectman's interview? Do you agree with his predictions? Do you think the BRICS nations could challenge the US dollar and disrupt the American economy? Could gold really blow up in 2025? Drop your honest opinions in the comments and let the stacker community know if you're investing in miners or prefer sticking with physical metals. Thanks for watching. Don't forget to check out this video over here. I'm sure you'll enjoy it. I'll see you on the other side.